This is not your father's value-based pricing. Whatever business you're in today, imagine for a minute that 80% of your sales are to one powerful customer. Just go with me on this. Now imagine for the last couple of years that customer pushed you to cut your technical support fees again and again because they said you were just too expensive. That's exactly the situation one of our clients was in when they hired us. After implementing a value-based pricing approach, that client increased their support revenues by 50%. That is 50% over 3 years. Even better, it was a win-win because the customer said they were very happy with the impact the support team had on their business. Value-based pricing made for a happier client and a step change in our client's financial performance. Welcome to Value and Pricing Secrets. My mission here is to help you improve your thinking about how to value and price your offerings. Let's dive more deeply now into value-based pricing. What are its strengths? What are its shortcomings? And if you're a value-based pricer, what can you do to improve your business performance? Before we move on, let me respectfully ask for your support. My commitment is to bring you world-class value and pricing content on this channel. If you want more, I need you to like, comment, and subscribe. It's the only way YouTube can understand that you value this content and want more of it. The primary reason companies focus on improving their pricing practices is profitability. And one of the most widely used pricing models, value-based pricing, typically gives the biggest boost to earnings. These are data from a specific research study of professional service organizations, but a swath of other studies across a variety of industries show similar results. Profits improve with more sophisticated pricing models. In particular, shifting from cost-based to value-based pricing tripled net income. Booyah! And that is just the start. Value-based pricing is not simply an evolutionary change. It is a step change, or even in some cases, an order of magnitude change in pricing practice and resulting performance improvement. As you are probably aware, there are three primary pricing models: cost-based pricing, market-based pricing, and value-based pricing, with cost-based pricing emerging from value-based pricing. So how are these three different? In my experience, each is different in its approach, information required, and the rules required for success. Let's look at a simple case study to illustrate the power of value-based pricing. Consider how pricing is often handled. A firm will research the market, develop an offering to solve the problem, and face pricing decisions as it's preparing to go to market. In other words, pricing is considered at the end of the development cycle. This is exactly what a dentist did in writing her book. I got a call from one of her business advisors. The question, what price should she charge for her book? The book was an operations manual that the dentist had written over the past 5 years as she established her own practice. The book codified best practices that she had developed for managing a dental practice. At dental conferences, books like hers had sold for $1,000 to $2,000. But instead of answering her question directly, assuming the book was the answer, that is, assuming a market-based pricing approach, I started with a value-based pricing approach. I asked her who the target market was, and she said that the target market was new dentists, really establishing their practices because they really don't have a good understanding about what to do, and it takes them a long time to get started. Then I asked her a question about their use of a book. Would they use it? I mean, it's great to buy a book, but you know as well as I do that 90% of books that are purchased are never read. And she agreed that even if somebody purchased a book, that it was unlikely that they would use it. So then I got down to brass tacks really with her, and I said, look, what's the value of this? How can you prove to a new dentist that this is really of value? And she explained that not only had she taken 5 years to write the book, not only had she worked with multiple dental practices to confirm the results that she was able to deliver, but also she opened up her book, this manual, and showed me a spreadsheet where she could take before and after measurements of the practice performance. And what was the result? For the typical practice, she could make a dental practice improve their revenues by $250,000 per year if the dentist followed her recommendations. So at that point, I asked, look, if somebody buys this book, they're not going to use it. Are there some other options we could look at? So we talked about the price. If you can create $250,000 in value for somebody, you want to be thinking, what could I build something? What could I develop here that could help that customer? If I can make them $250,000, what might they be willing to pay? And so as we talked about prices, we talked about not $1,000 to $2,000 for a book, but what if she offered a service with her, and she already had a team in place that could do this. She already did this with multiple people, multiple other practices. What if she offered a service? So we talked about an offering that was actually a service for new dentists, where she had a team of people go in and set up the dental practice office. And through that, then we talked about, well, if we did that, what kind of demand might she have? And we had to factor in the point that this would be a new dentist. So what would be the likelihood that they would purchase such a service and implement it? But being able to generate $250,000 more is really a good incentive for them. So the big lesson here is that you're tailoring the offering to the problem you're solving. In their case, they did establish a service and were successful at it. Is that always the answer? Not really, but looking at it through a value-based pricing lens really expands your view. It permits you to look at other options you may not have considered. And that's really the big lesson here. The big lesson with value-based pricing is you're tailoring the offering to the problem you're solving. Look, if you're solving a $5,000 problem, then maybe you're building a $500 solution. But maybe you're solving a $500,000 problem. And in that case, customers might be willing to pay $50,000 for the solution. And if you're solving a $50 million problem, then you should be building a $5 million solution. Look at it this way. If you've got a $50 million problem, someone comes to you and tells you you can solve it with a $5,000 solution. You're going to look at that a little bit skeptically. On the other hand, you go to someone that has a $5 million problem and say, look, or $50 million problem and say, look, this is going to take some time and effort to fix this. You're likely to be more credible. So your pricing needs to align with the value expectations the customers have. So now let's look at the details of value-based pricing. Its characteristic is that it's a very powerful and widely accessible pricing strategy, but it needs to be selectively applied. The approach is to estimate the differential customer value that you're delivering, and then to set a price that you can get a fair share. Look, the kind of information, though, that you need, and this is really the key to value-based pricing. You need to estimate the value that you deliver, and this is never an exact science. You need to understand how competitors are different, so there needs to be a fair drill down on competitor strengths and weaknesses. And finally, the prices of competitors. So what's the rules for success? In target markets where you have a competitive advantage, that's where you need to be focused. And optimize margin in the context of your desired growth. The typical manager here, this tends to be driven by strategy. What are we trying to accomplish as a business, and how can we use pricing to help that? To evaluate the strengths and weaknesses of alternative pricing models, we need a common framework. This is the value price surfboard, and its name is courtesy of my friends at Salesforce, who handed me that moniker during a training session several years ago. This framework for understanding pricing models is adapted by work by Dr. Irv Gross, who in fact is the individual who introduced value-based pricing to DuPont Corporation. And he went on to found the Institute for Study of Business Markets at Penn State. ISBM is the leading business marketing think tank in the world. A link to ISBM is contained in the description below. Now let's walk through the framework. The first thing you'll see is that when we think about our price, it's the traditional way. The price minus our cost is the profit margin that we will have. Now, for any business that's in business for any length of time, the value that they deliver to their customers must be higher than the price, or customers wouldn't buy. So we know that value delivered is at some high point, and here it's at the top of the surfboard. Now, the difference between the cost a company pays for inputs and the value that gets delivered to customers is described as the economic value created by the firm. Now, of all the economic value a firm creates, some of that value gets lost. Ask any experienced salespeople and they'll tell you customers can keep track of 2, 3, 4, 5 things at most about an offering. Everything else goes out in the wash. So when we're thinking about what value gets delivered to customers, we have to recognize that there's going to be a lot of that value that customers will simply not acknowledge, and it disappears. Now, what's the difference between the price and our cost? Another way to think about that is that's the value that we capture. That is the reward that the firm gets for its innovation, for its bringing its products and services to market. And finally, there's the value distributed. And this is really a key concept that's not often talked about in pricing. That is, the difference between the acknowledged value by the customer and the price they're paying is the value distributed. That's the economic driving force that prompts them to pay. If the value acknowledged is less than the price, they won't buy. So the value distributed is a key concept. And the important point here that I want to leave you with is that price in this context is not an endpoint. It's a variable, a slider, if you will, that you adjust to balance the value captured with the value distributed. The higher your price, the less value distributed, and the lower the willingness to buy. The lower your price and the greater value distributed, the greater willingness to buy. Now let's look at value-based pricing. Value-based pricing is a strategic approach that defines success by creating value for the customer and capturing a fair share. Value-based pricing is the most profitable pricing model across many industries, and value-based pricing is based on the premise that you have agency. That is to say, you control the value that you deliver. By configuring your offering and deciding on what part is product, what part is service, how robust your offering is, you control the value that you deliver. Number two is you control the value that the customer acknowledges. That is through your sales organization, through your messaging, through your advertising, through your public relations, through your social media. You communicate what the value of your offering is, so you have control over the value that customers acknowledge. And finally, you can set a value-based price. That is a price that customers that is based upon the differential value that you create. This is the key differentiation of value-based pricing. It says that you have control. With cost-based pricing and market-based pricing, to a fair extent, you are saying you're the victim of circumstance. In cost-based pricing, of course, you set price based on cost, and costs are determinable by finance. In market-based pricing, you're saying that there's a market-based price that you have to meet. Value-based pricing says you can be proactive with price in the marketplace in many cases, and that can have a big payoff. So this is a win-win for your customers. One of my favorite business strategy books is Blue Ocean Strategies, and a link to purchasing Blue Ocean Strategy is contained in the description below. Value-based pricing is a good fit for Blue Ocean Strategies, and let's take a look at the Blue Ocean perspective. You need to create an uncontested market space, and that's what value-based pricing does. It identifies how you're different from your competition and what that difference means in the customer's business. In that context, it makes competition irrelevant because you're making the case on a basis that's different than what your competitors do. You create and capture new demand. That is, customers that have this unique problem that they need to solve. And you really need to, and you break the value cost trade-off. So this is about innovating and pursuing new opportunities. Value-based pricing works because it creates a win-win situation with your customers. Because it is a win-win, value-based pricing can deliver phenomenal results. Double-digit revenue growth is possible with few additional costs. In some cases, particularly with new products and services, willingness to pay may be 5 to 10 times that what managers believe is possible. So what are the typical environments for value-based pricing? Well, first is new or upgraded products or services. Whether you're a cost-based pricer, market-based pricer, or value-based pricer, you can employ value-based pricing for bringing new offerings to market. 2, when you have a large, powerful customer who's pressuring you to lower your prices. For example, Exxon in the oil and gas industry that's been in a slump for a long time. They really don't care what the market price for your offering is. What they want to know is what is the price for them. 3, in markets where offerings have high fixed costs. For example, software or SaaS. In this case, you come to market with virtually no variable costs. So there's no real cost basis to think about for setting your price. So understanding the value your customers receive really is the only way to justifiably price your software or SaaS offering. And 4th, early in the offering development life cycle, especially in new-to-the-world functionality, when market potential is being evaluated. As I said at the outset, this is not your father's value-based pricing. Value-based pricing was initially developed about 60 years ago. Today, I believe it has evolved into 5 distinct variants that are simple value-based pricing. How do you bring a new offering to market? Number 2, strategic price offer design. This is particularly useful when you have complex offerings and you serve a broad market space with multiple market segments. Layer pricing. Look, when you first meet a customer, that's when they're most price sensitive. But as you develop a relationship and prove yourself in, the value of your offering improves. So layer pricing says, look, we need to set a price at the outset in order to close the deal. But we can't get stuck with that price from the outset for the course of the entire life cycle with the customer. So layer pricing says there's a sales cycle and customer life cycle approach that your value-based pricing has to fit into. Number 4, big data enabled. That is, as big data develops and you have greater and greater knowledge of your customers, how are you micro-targeting those customers with value-based pricing? And finally, outcome-based pricing. And that's where you tie your price directly to a performance metric in your customer organization. And our next video in this series will specifically talk about outcome-based pricing. So value-based pricing, what are the key advantages and disadvantages? Well, key advantages are that it can be selectively applied. You don't have to reinvent your organization to do it. It's instrumental in market-oriented product or service design. It encourages you to have conversations with customers outside the sales cycle because you need to understand what is value to them. It permits you to discover unexpected large opportunities even in down markets and empowers sales for price-value negotiations, especially with large, powerful customers. Disadvantages: the information you need may be difficult to obtain and you've got to make some investments in order to get it. Considerable effort, teamwork, and leadership are required for effectiveness. Political, cultural, and technical hurdles. So how can you improve your value-based pricing performance? Here's some questions to ask. First, how well does your research process actually test customers' willingness to pay? 2, have you expanded value pricing from products to services? 3, does your price management process include the process, training, and incentives to encourage good pricing behavior? 4, do your salespeople have the tools and support to effectively sell value and capture price? So let's sum up value-based pricing. Value-based pricing is a powerful and widely accessible pricing strategy, but needs to be selectively applied. It works well for both simple and complex offerings, in particular for pricing new offerings and pricing in new markets. It assumes a blue ocean perspective and so leads managers to value innovation and avoid competition. Value-based pricing works well to improve profitability with large, powerful customers. Financially, it outperforms both market-based pricing and cost-based pricing, but does take more effort to achieve that end. And finally, value-based pricing performance may often be improved through better price management and sales practices.